what I tell my kids. The joy is not in the destination, the joy is in the journey. And if you don't enjoy that process, or if for somebody, if that is really difficult or that's trying or that's stressful, being an entrepreneur may not be the right fit.
Wonderful. Okay, well, welcome everybody to the latest episode of the Building Better Portfolios podcast with the tagline "And Better Lines." You've got Josh here, your co-host with Paisley, and we are so excited to have Michael Bell here. I've known Michael for, we're probably going on something like 4 or 5 years at this point. Yeah. And so it's great to have you here. For those who are less familiar with Michael, Michael is the founder and CEO at Meketa Capital. Prior to that, founder and CEO of Primark Capital. Prior to that, president and CEO at Jackson. So just a long, great career in the finance industry. And so we're super excited to have Michael here with us. So we'll just go ahead and dive in, Michael, if that's okay.
Yeah, that's awesome. Thanks for having me, and look forward to the discussion.
Yeah, likewise. Well, we'll start with our classic questions that we always ask our guests at first. So why don't you just tell us a little bit about yourself and your career?
Sure. So I kind of look at my career, maybe not by jobs, but, kind of the phases of my career. So I think, the first phase, all the way back, decades ago, was really one of kind of building my tool set, right? And things that were going to help me going forward. And so what I did, I started off as a CPA. I was with KPMG, working with financial institutions, real estate companies. And that's really, where I learned how, money actually moves and how businesses work really kind of underneath the surface. Then, I spent the better part of a decade as a deal lawyer in corporate finance, taking companies public, doing M&A work. And so, by my mid-30s, kind of the tool set, I could basically kind of work my way through a balance sheet of a company, and I kind of could structure deals and negotiate transactions. And, that taught me, accounting really kind of taught me the what, and, kind of the deal work and law taught me the how, right? And so then I kind of moved into the second phase of my career, which was really building companies for other people. And so, I jumped in from advising on deals to really running businesses. And I think maybe the defining chapter of that was, more than a decade at Jackson National, which was part of Prudential PLC, a global financial services company, where I built and ran a retail asset management arm of Jackson. It was called Paisley Capital. We had a couple of groups in there, but about $20 billion of assets, 400 employees or so. We built 55 liquid alternative mutual funds there, and built a big platform for advisors. And that's really where I learned to scale, people, distribution, product, all of it. And then I think the third phase of my career, it's one that I'm in now, is I transitioned to building companies that I founded and financed, right? And so I ran a company called Global Financial Private Capital. It was about a $6 billion independent RIA in Florida. And then most recently, I founded Primark Capital and Meketa Capital. It's a side-by-side sister companies that, with a very specific mission. And that's really to take, private market strategies from the largest institutions in the world and really make those types of strategies generally accessible to financial advisors and their clients. Okay. And so that's really what led to, this partnership with Meketa Investment Group. And so kind of over my career, it's really, the tools, then operator, then owner, kind of each chapter kind of made the next chapter possible. And so, and the third chapter is kind of, why we're here. And I think what we're really want to talk about and discuss today.
I have a quick question, actually, like a common theme or thread between all the stops you've had along the way in your career is having what I would consider to be a very entrepreneurial spirit. And so those of our listeners that are maybe, in that type of role currently or considering stepping into an entrepreneurial type role for their careers, like, I mean, I'm sure it's hard to distill down, but what types of like personality traits or what types of characteristics do you think have made you successful or at least enjoyed the ride? Because it is a unique skill set.
Yeah, so I think just a requirement for that, like it is a standard table stakes, is optimism. Okay, things are going to go wrong. Okay, and you have to be a problem solver across the board. Whether you're, kind of working on the accounting side or the law side or building companies or whatever, we all solve problems every day, and it doesn't matter if you're, a beginning accountant right out of school. The level of problems that you have or the type of problems you have are a little bit different than running a company. But if you don't embrace that and you don't enjoy kind of solving those problems and really kind of rolling up your sleeves and getting after it, and you don't have that optimism to do it, it's going to be very difficult to really kind of embrace an entrepreneurial perspective. So you have to, what I kind of tell my kids, the joy is not in the destination, the joy is in the journey. And if you don't enjoy that process, and for somebody, if that is really difficult or that's trying or that's stressful, being an entrepreneur, may not be the right fit. So you have to enjoy what you're doing, be optimistic about it, enjoy solving problems because you're going to have different problems every single day.
Yeah, that's great advice.
I love that. And that resonates with me. And also what you talk about, like teaching your children. I've got 3 younger kids at home and I'm all about the journey, right, with them and just helping them understand that it's like, no, like it's all about enjoying the now and not being so focused on where you're going. So that's fantastic. And just, optimism, so important in everybody's life. Well, Michael, why don't you tell us just a little bit about yourself that maybe most people don't know? I'm interested to learn this.
So I love how you guys, kind of ask the personal stuff and get a little vulnerable. So folks in my office, as I point kind of out to the floor, may know this, but most folks don't. So I'll frame it up as 100,000 push-ups. Okay. So what most folks don't know is this year, I committed to doing 100,000 push-ups, and there's kind of a reason. For
this is
that.
Insane.
Well, okay, so insane. Okay, that is the typical response.
Yeah.
That you hear. It's like that's impossible. Okay, and most tasks, whether you're an entrepreneur, whether you're starting a business, whether you're trying to get in shape, whether you're trying to lose weight, or whatever it is, the task sometimes at the outset seems impossible. But here's the thing, and this is really why I'm doing it. 100,000 push-ups a year, it seems impossible, but it's only 275 push-ups a day. And 275 push-ups a day seems like a lot until you realize it's only 11 sets of 25 push-ups. I can knock out 25 push-ups between meetings. Before this call, I did 25 push-ups. While the coffee is brewing, I can do 25 push-ups. So really 11 small, completely doable moments in a day, right? And so that's kind of a life philosophy, for me, that when you kind of look at the really big, hard, daunting things in life and in business or whatever, it's really not that hard when you break it down into really small tasks, right? And when you're running a marathon, you don't go out just tomorrow and run a marathon, but you train and you break it down. Okay, the marathon itself may seem daunting. The 100,000 push-ups may seem insane. Raising, $100 million fund, building a company, launching a platform, back at Curian, building a $20 billion platform. That doesn't happen in a day. Really what you do, is you build it, 25 push-ups at a time. And so the magic for me kind of in all this and kind of an entrepreneurial lifestyle in terms of philosophy, in terms of what you're doing, the magic really isn't in the intensity, kind of doing that. It's in what I call, and what I, again, preach to my kids, it's this relentless consistency. It's like showing up every single day, and you do that small thing, and it seems impossible. The impossible number kind of takes care of itself if you do that small thing relentlessly, consistently, every day. So, nothing is daunting, as at 25 reps at a time. The impossible is just consistency compounded. So,
that's amazing.
So that's something that I don't share a ton, but the folks in my office see me dropping down and doing 25 push-ups every now and then. So.
I love that. I mean, also too, more importantly though, the messaging behind that, like you said, is everything in life requires effort. And so if you compartmentalize and break that down into smaller bite-sized things, then you said it's the journey rather than the destination. And you've motivated me, Michael, and I'm going to get off this podcast and start doing some push-ups. Maybe I'll start with like 15.
Well, so the concept of like these really the hard things really just aren't that hard when you really kind of break them down into doable small tasks. And the hardest part of the journey is getting started. So
I agree with that.
Love that. I also love, my business partner and I talk about this all the time. Like, let's be focused on the process. And even Paisley and I have had this conversation multiple times about the podcast, is like, hey, let's just focus on the process of making the podcast and just get the content out there and not be so worried about like how many clicks we get or how many views, because that, like, if you focus on the process and you do a really good job, I find that everything else will come along with that.
Right. Yeah.
That's awesome. No, very inspiring. You've inspired me as well. Well, Michael, let's shift the conversation to Meketa Capital, and would love to kind of hear about how, Primark and how Meketa Capital came together and why they came together and what are some of the benefits of that partnership. Maybe give us a little bit of that story.
Sure. So I founded Primark in 2019, and around kind of what I saw is one of the great inequities in investing, and really the best performing asset classes for the last several decades, private markets, private equity, private real estate, private infrastructure, private credit, was essentially walled off from everyday investors. Institutions, whether it's pension plans, endowments, sovereign wealth funds, they've allocated to private markets for 30 plus years. But advisors and their clients, they kind of been locked out of that market from, accreditation rules and, big, high minimums, capital calls, K1s, 10-year lockups and kind of all that. And so, fund structures, interval funds, tender funds, they began to change that equation, 6, 7, 8 years ago. And so we built a registered interval fund. It's 1099 tax treatment, low investment minimums, no capital calls, no accredited investor hurdles, for the fund itself. It's a vehicle that really gives advisors, something that their clients can actually use. And so, but what I learned really from day one is that the structure and distribution and awareness and education, that's really not enough. You really need kind of an institutional caliber investment capability behind all this. The deal sourcing, the diligence, the access to some of the top quartile investment managers, private market investment managers in the industry. And that is what led me to Meketa. So Meketa Investment Group, it's one of the largest and most respected institutional consultants in the country. I mean, they have clients that include CalPERS and CalSTRS and Texas Teachers. They've spent decades advising pensions, endowments, and foundations on exactly these asset classes, these private market asset classes. So founded Primark in 2019, and then in 2023, we really came together with Meketa. I approached them, and they were in the institutional market. We were in the wealth management market. And I said, hey, we would love to take your institutional capabilities, okay, and open that up to the wealth management space, to the RIAs, and really take everything that Meketa built for the largest institutional investors in the world and deliver it to independent advisors and their clients. And so that's really what brought Primark together with Meketa, and we formed a sister company called Meketa Capital. So, Primark, brought the wealth channel vehicle and distribution DNA, and Meketa brought 5 decades of institutional investment horsepower together, and it's been kind of a great partnership from day one.
This sounds like just this perfect confluence of like the right vehicle, right? An easy to access vehicle for, democratizing this type of asset class to individuals. So it's relatively easier to access. There's not all these barriers or hurdles that people typically would have to jump through in order to get access to these type of investments. But then also bringing in this partnership with an institutional, like just fantastic asset manager with all this experience. This is very exciting.
Yeah, it has been a great partnership, and I think kind of looking at the benefits of partnering with an institutional partner, like Meketa, the benefits from I think for us, for me, kind of starting this company, and the benefits for advisors, kind of in the wealth management space, they're really kind of hard to overstate, but. When you kind of look at what Meketa kind of brings to the table on this, they have the scale of their expertise. They have roughly, 280 investment professionals, a research and diligence engine, that almost no, wealth channel asset manager can match. It's huge. They've been doing it for 5 decades. And that tenure, nearly 50 years of advising institutional investors through every market cycle, since the late, 1970s, is a huge wealth of experience, bringing it from the institutional environment kind of into the wealth management space. And then, I think that coupled with Meketa's deal flow and their diligence at an institutional volume. So the Meketa platform, they review on average, about 800 private market products annually. Okay. Almost every, top quartile and second quartile private market product that comes to the market, they're looking at and reviewing in depth every year. And that's in conjunction with about 700 manager reviews a year. And so, when Meketa evaluates co-investment opportunities or manager opportunities, they're not seeing it cold. They've probably looked at that manager, over the last 4 or 5 funds that manager has rolled out over the last decade. And so what they're looking at is a pattern of recognition built on, hundreds of reviews annually, not just a one-time review. And then I think maybe the most important thing that they bring is access. Top private equity firms in the world know Meketa because Meketa is a gatekeeper to the institutional clients. And they've been in that gatekeeping role for decades. And so that really opens up doors for retail investors and registered investment advisors to managers and co-investments and terms that really simply can't be accessed in any other way. So, when an advisor, allocates with us, they're not getting a retail product with an institutional label. They're actually getting the institutional machine that's just redirected kind of into the wealth channel. So, when you talk about 800 product reviews or 700 manager reviews a year, that's really not just kind of a marketing tagline. That's really, I'll call it the institutional muscle memory of Meketa.
Michael, I know that you all have focused on two major asset classes in the alternative space. You focus on private equity and you focus on infrastructure. Do you mind talking to us a little bit about kind of the strategic decision making behind that? But then also you've used this terminology co-invest, which maybe not all of our audience understands. Do you mind helping? And I think this is a real kind of advantage that you all have in your approach to investing in the alternative space. Like, walk us through what does co-investing mean versus other forms of investing in the private markets and why you all view that as an advantage.
Sure. So first of all, to your first part of your question, kind of private equity infrastructure. We looked at the landscape, 6, 7, 8 years ago, and most of the landscape was in private markets. Basically 4 sub-asset classes in private markets. Private credit, private real estate, private equity, and infrastructure. And what we really wanted to do was look at those areas that really weren't covered off that well, that were hard to access, hard to get access to. And when we looked at the landscape, again, 6, 7 years ago, there were a lot of private credit funds kind of in the market. And there were a lot of private real estate funds in the market. There wasn't a lot of coverage in private equity, and there was almost no coverage in infrastructure. So we wanted to do the difficult things for advisors and make that access point easier. So that's why we selected private equity and private infrastructure to begin with. And then we wanted to go one step down in terms of what is the most difficult thing to access in the private markets. So I think the dominant kind of retail private market model is a fund of funds, really allocating to dozens of underlying funds. And what you end up when you go and just buy a private fund and you actually have a fund of 30 funds, right? It's a fund of funds. One of the things you're doing is you're layering fees on top of fees. And then you end up with really indirect exposure to literally thousands of private companies. Now, there's nothing wrong with that, but you have to really understand what it is. That is private market beta. Because you have thousands of private market companies, you're buying the asset class, right? With an extra layer of fees. And so, I think when you look at co-investments, our approach is co-investment driven, and co-investments is fundamentally a pursuit of alpha, right? So what we do is, in what a co-investment is, let me kind of explain that first, and then I'll tell you, it'll be obvious kind of why we go there. So when a big fund makes an investment, they generally have some structural limitations of how much they can invest in any one particular company. Okay, let's just kind of make up an example. Let's say a general partner has a $10 billion fund, and they may have a limitation. They can't put any more than 10% of that $10 billion fund in any one investment. You don't want to be over concentrated in a sector or in a particular investment. So that leaves a cap of $1 billion that you can invest in any one particular company. Let's say you run across a great company that you love, you've followed forever, but it's $1.2 billion to buy it. You don't want to pass on that. You want to invest in it, but you can only put $1 billion into your fund. So what you have is this gap financing for that other $200 million. Where are you going to go find that $200 million? Well, what the general partner does is they go to their best LPs, the people that have invested with them the longest, and those that have a great relationship. We know everything's kind of built on relationships. So Meketa has been one of those massive investors in private equity for decades with most of these general partners. And so when they have a gap financing need, they need to find somebody to absorb that additional $200 million in that investment. They come to their LPs. Meketa is in the front of the line for that. So what they need is they need $200 million of investment capability, and they need it within a very short period of time. generally within a 3 or 4 week period of time. And the benefit to the LP investors is we get that investment with no fees attached to it, 0 fees. So $1 billion is going into the fund, and that fund is charged 2% management fee and 20% carried interest. The co-investment, that gap financing for that other $200 million is free. So we step in and we take that investment and we put it into our fund, and the layering of fees is actually 0. Okay, so huge strategic advantage. And that strategic advantage is built on the access that Meketa has had for decades. And so we also invest directly into those individual companies. And so you're getting, top tier private equity sponsors with companies that they have a high conviction in. And we can dial in the valuation, the investment thesis. We're not investing in blind pools. We're actually choosing, the investments one at a time based on the full diligence. So we have selectivity, in terms of what we invest in. Meketa reviews hundreds of managers a year, and our deal funnel includes that, and we select the alpha that we think is we select the investments that we think are generate the best alpha for our investors. We have this massive fee efficiency. The co-investments are offered at no fees, compared to funds that have this 2 and 20, fee structure, attached to it. So, and that really drives what we kind of look at as, intentional portfolio construction. It's not accidental exposure to thousands of companies. It's specific exposure to companies that we select from high conviction managers. So, at the end of the day, fund to funds is private market beta, and co-investing is the pursuit of alpha. And we choose every investment that we make, one investment at a time.
That's super helpful for, I think I would imagine, most of our listeners, because oftentimes private markets coming down market, which I know has a negative connotation, but moving from the institutional world into more the advisory world has carried with it, I would say, a lot of baggage, in the sense that people say, like, oh, we're packaging things, like you said, adding on layers and fees, giving the retail investor, the investor, this like diluted form of private markets. So they're getting charged a ton of fees, and it's not really the same type of investment that institutional allocators or asset owners are getting, which, as you've just described, especially through these co-investments, and I came from the institutional world, that's very much the same type of exposure and deals and pricing and opportunities that some of the largest sovereign wealth funds and pensions, endowment foundations have been getting for decades. So it's super exciting that this is now available. And to your point, and this kind of transcends private markets, but the topic or the debate of active versus passive, if you take a step back and think about why you're accessing private markets to begin with, generally the first thought is not like, I just take the market. It's an alpha generating sleeve within the portfolio, right? You're taking on what oftentimes can be coined as like, more leverage or greater risk or volatility, even though some of these, of course, have kind of mark to market less volatility. But you want to be compensated for taking that on. That's a unique source of risk or return in the portfolio. And so I think a lot of allocators would say, like, if I'm going to allocate to private markets, like, why would I want a return stream that's just kind of blah, right? So I'm glad that you kind of broke down that component as well.
And just to add to that, I mean, I think this is something that you've seen in the institutional world for a decade plus is, hey, we'll allocate to this private equity fund, but we want the right to be able to co-invest. And so if you allocate 100 million, but then you also then allocate another 100 million to that manager through co-investments, it's a way to get a kind of a fee reduction, or optically, right? You're only getting really charged on the first 100 million. You're not getting charged on that second 100 million, and so it kind of allows you to blend that fee across more assets. And that's what I love about your approach, is that you're saying, hey, like this is a better, more fee friendly way, and that it just means that your hurdle from a performance standpoint, to get the same performance as another fund with all the fees is lower. So if you can get similar performance pre-fees, then you're farther ahead. So I think it's a very unique way and a unique kind of mousetrap that you guys have built.
Yeah, and some of that is really just luck. I think to build kind of good businesses, you have to have a little luck along the way. And we found a partner that has preferred access to that. And you're exactly right, Josh. The private equity, private investing arena has been able to put a stake in the ground on their fees. And their fees have remained at 2 and 20 for the largest investors forever. Okay, for 3 decades, 2 and 20 is the structure, and you haven't really seen margin compression at that level. In mutual funds, you see margin compression for the last 2 decades. In private equity, you haven't seen that margin compression. The way they actually trade off and help reduce fees for their best clients is they give them access to co-investments. You start with the 2 and 20, and then you go to 0, and you leverage down, you average down your costs over time if you want to take advantage of some of these. And so we've been in a very fortunate position with Meketa Investment Group, and they do stand at the front of the line of access to those co-investments. And we want to deliver that value and that benefit to retail clients through advisors.
So we use the term interval fund. Interval funds are kind of semi-liquid investments, right? You can put your money in any day of the week, but then there's certain liquidity windows throughout the year, whether it's 2 or 4 liquidity windows throughout the year. And then those liquidity windows tend to be about a 5% redemption cap, right? So, you'll allow 5% of the fund to be redeemed. And so we're in a very interesting environment right now. We've already gone through this with real estate. We're seeing this now with private credit, where private credit funds have been a little bit under pressure, right? And they've been in the news a lot, not nearly as much as they were earlier this year. But we're seeing a lot of those private credit funds hit these redemption caps. How do you guys think about liquidity? And then also, what do you think about these, like that interval fund structure in terms of like, do you think this is a defect, or do you think this is a feature? I'd love to hear your thoughts.
No, great question, and timely and really important, because the headlines you're referencing, are real, and they hold, I think, real lessons for advisors and clients. The first principle that you really take out of this is super simple, that you never promise liquidity, when the underlying assets can't deliver that. Okay, so most of the stress that you've seen in what you've referenced in real estate and credit really comes from a structural mismatch, right? Quarterly or monthly liquidity promised against assets that really take years to sell, or sometimes there's leverage kind of on top of that. And so, when redemptions spike, the structure gets tested. Gates go up, and then there's trust or expectations, kind of get damaged. We really approach it a little bit differently, and it's kind of in layers, right? And we structure honesty in that, and what I mean by that is the interval structure is purposefully built for semi-liquid assets. It has redemptions at stated intervals in stated amounts, and we disclose that up front, and we really treat that as an engineering constraint, not a marketing feature, right? And so advisors and clients should really know exactly what they own and, the liquidity that it offers. And so, in both, position size accordingly. And so, we manage the portfolio for liquidity, in addition to the return profile. So, we have deliberate attention that we pay to the liquidity profile of the underlying holdings that we have. We maintain cash and liquid sleeves, and we stress test that against redemption scenarios, and most other firms do as well. But we do that the way institutions do it as well. So we look at those scenarios really before they happen, not while they're happening. So, and then we also, maintain multiple liquidity levers, through credit facilities, and the ability to manage position sizing for each individual position. And we also have access to the secondary market and, several tools that, kind of no single redemption window forces, selling good assets at bad prices type of thing. So, and I think the last kind of piece of this in terms of liquidity management is just communication. Most liquidity crises, if you will, and I'll kind of use that in quotes, in this space, are really expectation crises. And what I mean by that is, advisors should really understand the structure going in, and because the structure works exactly as it's designed. So, an interval fund isn't a liquid product, and it shouldn't pretend to really be that. It's semi-liquid. And when you look at that, when you understand that, when you respect that, it's a remarkably good bridge between institutional assets and individual investors. And so I think a lot of this starts with education and making sure that advisors and clients both know and understand exactly kind of what they're investing in. So that's kind of where we start, and when we really kind of look at the liquid and kind of semi-liquid alternatives in a well-diversified portfolio.
I'd love to maybe pivot to think about just the current market backdrop, and as it relates to the infrastructure fund that you guys operate. It seems to be an extremely topical part of the market, whether it be liquid or illiquid, private or public, just this theme around real assets and inflationary plays. Have you seen increased interest in the infrastructure fund over, say, the last 6 to 12 months? And then maybe looking forward, how are you positioning infrastructure as an asset class, and more specifically, like the direct exposure to infrastructure versus some of the listed? That's something that's kind of near and dear to my daily conversations in my day job. So I'd just be interested to hear your thoughts.
Right. So headlines are driving a ton of that appetite and conversation that we're having today. So it's no secret of the need for infrastructure. Infrastructure is around you every day, whether you're driving on roads or bridges or getting on an airplane or shipping containers or utilizing your cell phones and cell towers. All of that is infrastructure. It surrounds our daily lives, and there is a massive underinvestment today in infrastructure. So there is a massive need for capital, and so you're seeing that in the institutional arena, and the institutions can't absorb or can't provide all of that capital. So now you're seeing that come into the wealth management space with retail investors, right? And so when you look at institutional assets, you're investing in durable assets sometimes with contracted revenues. And the contracted revenues that you may be buying in a cell tower or a seaport or a toll road, sometimes those contracted revenues are contracted for decades. Okay, so it's a durable asset with revenue streams that are very predictable because they're contractual. And so, in terms of a low volatility asset class that complements a yield vehicle that may have some uncertainty attached with it, infrastructure provides a level of certainty that you don't see in a lot of other credit vehicles, for example, or even real estate vehicles. And so it's a great complement to a portfolio because of the consistency and the durability of the underlying assets and the revenue streams associated with that. So we're seeing a lot of conversation about it. It is one of the biggest needs in the institutional investing arena that you're seeing today. And we're, super happy to be able to put that in a structure that's available for retail advisors or retail clients through their advisors.
Yeah, I think it's super exciting. I mean, infrastructure has been one of those asset classes, especially in advisor portfolios, that has long been viewed as kind of boring. Like you said, toll roads and these contractual income arrangements where it's like, yeah, I get it, but fine. And now that the AI has entered the chat, essentially, and we're doing a lot of CapEx and the data center build outs, the need for, the power and energy and like the reshoring, like that theme just seems to be rising very quickly to the surface. So I would anticipate you guys will see a lot of interest in that space in the next couple quarters.
The next couple of quarters, next couple of decades. I mean, we're massively underinvested in that. I mean, just if you look at some of the headlines and the investment needs in data centers and energy alone to just fuel this first leg of this next thematic, investment period in AI, the investment is massive, and most of it is focused in infrastructure.
Well, Michael, we want to end with a couple questions. One was, what's the worst trade or investment you have made, and what did you learn from it?
Yeah, so this is it's an easy answer for me. It wasn't like a particular stock or a ticker or something like that, but it was literally a company that I invested in, and I was family office backed, and I invested in this company called Global Financial. So on paper, great company, $3 billion RIA, strong economics, good distribution, and the term sheet. When we kind of structured that and we discussed it with, the team that we were buying out, looked great. Okay. And so I walked in, to that deal, with, overconfidence. I'd run a big company, 400 employees, $20 billion. I'd structured 100 deals and taken companies public. And, one of the things that we really had to do kind of in this company, one of the key points was taking an RIA with 100 advisors, 30 of which were kind of really important in there. And most of them had done business a different way. They had really kind of come out of the brokerage arena. And so they were really transactional. And we needed to change the culture and restructure it into more of an advisory business. Okay. And so part of the theme or kind of the investment strategy was changing the culture. And so I thought with, my overall question there was, how hard could it be? Right. Culture is really not a line item that you can restructure. So it turns out that it was super, super hard to do. And, the lesson that I learned there, even though, we took a $3 billion company and, grew it into a $6 billion company and then sold it to a public company, trying to change the behavior of people, trying to change the culture of a company, that you do not underestimate that. And, my kind of learning, kind of on that is, the term sheet that you put together on any deal, whether you're an advisor trying to sell your company, whether you're trying to buy another company, that term sheet always looks better than kind of the operational reality of a company. The spreadsheet's company, the spreadsheet's clean, right? But the company is human. So it was a good lesson to learn, a hard lesson to learn, that changing culture sometimes is important, but it's a lot harder than it looks.
Well, good thing that you're an optimist by nature, because that would be extremely difficult if you were not. So thank you for sharing that. Maybe as we wrap up, just briefly, we always like to ask, and this is more for you to give a shout out, if there's any individual or person in your life that has made a very meaningful impact on your career, and why that was, we'd love to hear about it.
So I kind of look at that. I love you guys that you ask, kind of some personal kind of behind the scenes, kind of what drives you type of thing. And because when you do things and when you build things, nobody really does that alone. And, so, I kind of look at this as kind of a two-part, as you mentioned, Paisley, shout out, but it's really, the first kind of the biggest impact, in my life has really been, my faith. It's had a material impact, on my career, and it's reframed kind of the entire question of really, why I work. I'm 62 years old, and I describe this chapter of my life and kind of what I'm doing and why I do it as my significance, season. The first couple of decades in my career were all about success, building a tool set, building companies, and kind of proving to myself that I could do it. And what I'm doing now is really about significance, and that's really legacy and mentorship, and what I believe my actual purpose is, and unlocking potential for in other people for doors that they really can't kind of unlock on their own. So that's been important to me, my faith, and that's kind of driven me, and I think unlocked doors for me. But the second there is, and I probably should mention it first, but it's really my wife. I've been married 28 years, and every risk that I've taken, in my career, she's been, kind of right there with me. And whether that's, leaving kind of a, big successful law practice, take an operating role in a company, or leaving a big corporate company to run an independent firm, or pull out a blank sheet of paper and, invest our own capital in a company called, Primark. All those, decisions were made with her, and we did that collectively. A lot of people, when you kind of pull up a website, you see the founder, you see the person there, and sometimes you don't see behind the scenes of who really helped you get there. So my faith has given me kind of the purpose for what I want to do, and my wife has given me kind of the encouragement and the help and support to get there. And so everything I've done, whether it's companies I've built or funds that I've launched or deals that I've done, it's really kind of been built on those those two foundations. And,
yeah.
So
I love that, because the message of we don't build things on our own transcends whatever role you're in, whatever industry you're in. No one got to the top by themselves. And the sooner that we can all realize that, drop the ego and lean into our resources and give feedback and praise for those that helped us along the way, I think it just makes us happier. It makes those around us happier. So really appreciate you sharing all of those insights. I want some kind of like a countdown, like where I can see how many push-ups you've hit. Okay. And anytime I go check a website, like where are we at?
No, so I've got this little countdown counter that I use every day. And so you can see, so here's my daily. So I'm at 75 today. So I've done 3 sets of 25. And then you go to all. And so I'm at 44,600. And so when you actually do the math, by the end of this month, I should be at 50,000. So I'm on track. Wow. I'm on pace. I'm kind of right there. So
this is like deserves the clapping emoji here. Yeah, that's so awesome. Impressive. Well, thank you for carving out an hour. You could have knocked off another 300 push-ups in the last hour, but you chose to spend it with us. So thank you for joining us, and thanks, Josh, for inviting Michael to be on the podcast.
Of course, thank you, Michael.
Awesome to see you guys. Thanks for having me on. Really enjoyed spending time with you guys.
The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.